How's it going, guys? Welcome back to the Capital Mindset Show. We're your hosts, Austin and Fabio. And Fabio, what are we looking at here today?
So today we're looking at one of the most prized valuation metrics used by both retail investors and some industry professionals, and that is the price to earnings ratio. So what we're going to go over today is what is the price to earnings ratio? What are some of our critiques about the price to earnings ratio? And what are some alternatives you can use in conjunction with the price to earnings ratio? So what we're going to first start with is Austin, who's going to explain to you what the price to earnings ratio is and some of our critiques.
So before we dive into the rest of this video, it's crucial that we define what the price to earnings ratio is. Now, in essence, the price to earnings ratio, or PE ratio, takes the current price the security is trading at, and it divides it by its net income or loss per share outstanding by the trailing 12-month or forward basis. Now, our first critique of the PE only approach is that non-cash expenses do not actually represent real cash outflows. Now, non-cash expenses typically include depreciation, amortization, goodwill impairment. And with this, especially with depreciation, you can calculate depreciation in multiple different ways. So, for example, here, we see accelerated depreciation and straight line depreciation. And accelerated depreciation takes more in the first year and then later depreciation in the final years. And straight line depreciation just takes the same amount throughout each year for the useful life of the asset. Now, CFOs will use these methods to accomplish goals or to boost performance. However, earnings management, there's a very, very fine line between this and then earnings management. And earnings management is timing earnings, and it's technically illegal. So now I'll let Fabio kind of explore the next part of this video as well.
So piggybacking off of what Austin says, Charlie Munger is famous for saying, show me the incentives and I will show you the outcome. So basically, if pay structures of corporations are set up so that earnings metrics are a way for management to meet their goals or boosting the stock price over the short term to meet their goals and get their compensation packages, then there will be incentives for management to do these short-term boosts, whether or not technically they are illegal. There's a difficulty in proving that they're doing such a thing. Okay, so it's just something that as investors we do have to be mindful of when we look into the accounting of our businesses. Now, there are some things that I want to highlight. So these things you won't really find in your textbooks. And I'm not sure if it's really talked about anywhere else, but it's a concept of an upside surprise and a downside surprise. And I'll showcase some examples of what I mean by that. So an upside surprise is easily defined as when cash flows are greater than the net income. And basically, over time, there can be differences between cash flows and net income. But over time, over the long term, cash flows and net income kind of meet at some point, either give or take in net income or in the cash flows. And a downside surprise is simply defined as when cash flows are less than net income. So we can kind of say a general rule of thumb is that an upside surprise is a good thing or can be a good thing, and a downside surprise can be a sign of a bad thing. So you don't really want to see a downside surprise. So I'll put up an example right here on the screen of Amazon's statement of cash flows, and we can kind of get an idea of what an upside surprise looks like. So back in 2016, the PE of Amazon, if I remember correctly, was closer to like around 100, but it was a very high number. And what people were pointing to was the PE as a way to value Amazon. They were saying that Amazon was very expensive. However, if you took a different approach and you looked at the owner's earnings or the free cash flow, and you kind of use that as a valuation metric, you got a different story. So what you kind of see here is that in 2016, the net income is substantially lower than the free cash flow. And this is an upside surprise. You can see this continuing all the way to 2020. And in the trailing 12 months, this changes. However, I'll talk about why this might be changing in a second. I just want the audience to see right here is that Amazon has consistently had an upside surprise, which is generally a good thing going forward because that's something to look forward to. And that could be because the business is incurring some expenses on a GAAP basis that aren't necessarily cash expenses. Now, Amazon is a business where they are cyclical, meaning some parts of the years are different and more important than others. So you can kind of think of the holiday season. So don't take the trailing 12 months at face value, kind of understand that the trailing 12 months, you kind of have to let it settle and for the full year of 2021 to be fully reported in. So it still might be an upside surprise, even though currently it does show a downside surprise. So the moral of the story here is that while Amazon looked expensive in 2016 on a PE basis, if you use that metric alone, you would have thought that Amazon was overly expensive.
So Fabio, kind of piggybacking off of that, let's kind of explore what we oftentimes would like to call at Capital Mindset, the usage of arbitrary thresholds to decide to reject or accept a PE ratio.
Yeah, so some of the arbitrary measures that we often see sometimes is someone setting a target for a PE. Now, in conjunction with all the problems that we discussed about the PE ratio, setting an arbitrary target can often be a big mistake. So if you set the PE, for example, 20, you will pass on great, fantastic companies that are perhaps for some reason having a higher PE temporarily or perhaps several years. And over time, the cash flows, which are higher than the PE, will catch up. And you will see eventually that the earnings, like on a GAAP basis, will reflect the true performance of the business. And other times people use something called a forward PE. So the problems with forward PE, on top of everything we've discussed previously about PEs in general, is that forward PE relies on future projections. And what we try to stress in Capital Mindset is that future projections are not so simple to predict. What happens with future projections is that you have to account for a certain degree of uncertainty. So if I think that the X company will deliver this amount of net income, and I'm not backing up reasons why, you should be very careful about listening to people that do that. And utilizing forward PE oftentimes is by using just simply analyst projections, and analysts can be wrong. So definitely as an investor, you need to prudently make your own kind of projections as to the business, and maybe even make a range of projections, because oftentimes you're going to be wrong, and you want to set up a different kinds of simulations for yourself. And if the low end still makes sense for your investment, then I would say that it could be something that you might be comfortable investing in. Now, on top of that, we want to discuss some alternatives to the PE. So some alternatives to the PE can include the price to free cash flow. And as we were discussing earlier, the free cash flow is oftentimes a better judgment of the actual performance of a business. And it is the actual cash that's coming into the business, and it can reflect what the business can actually use to give you, the shareholders, some money. Now, what you want to watch out here for is some one-time cash injections. This could be from winning a lawsuit or some sort of one-time payment from another business for whatever reason. So you want to be careful with that, because that does artificially increase the cash flows in the short term. You want to kind of stabilize cash flows over time and make sure that you are projecting of an appropriate amount into the future and not an artificially raised one. And then the second alternative that you can use in conjunction with the PE ratio is the PEG ratio. Now, the PEG ratio is utilized by those who want to take into account growth, because the PE can look expensive, but it's without context. Okay, so with certain context, a PE ratio can actually be cheap. For example, if you take a PE ratio of 30, on the surface, it might look expensive, but if the business is growing at 40% a year for the next 5 years, that's cheap. Okay, but that in that specific circumstance, that is the case. And again, you can extrapolate this and say, if a PE is 100, but you believe the business, for whatever reason, and let's say you're right, is going to grow at 150 or 100% a year for the next 5 years, that business could actually be very cheap. Okay, so it all depends on the context, and the PEG allows you to kind of decipher that context, whether or not a business is cheap, and you use in conjunction with the PE. Now you can take this and you can actually start mixing these around, and you can say, you can use the price to free cash flow along with the PEG. And instead of doing PE divided by growth, which is what PEG is, you can say price to free cash flow divided by growth. And that's actually the beauty of finance, because it's both an art and a science. So you can actually start to mix in different accounts, and maybe you actually end up discovering a new way of evaluating a business's performance or cheapness that you can then customize in your own way. And everything is just basically up to you and what you're comfortable with and what you believe is correct. Here at Capital Mindset, we're just trying to open your mind and trying to guide you guys in the right direction and try to think for yourself, because we're trying to teach you guys how to fish and not give you the fish. And That being said, we're going to have an article, an extensive article on the P ratio, where Austin will go into greater detail on the accounting practices and things that can change, with some examples of the depreciation methods that can be used on our website. And it's all free to see. There's no paywall or anything like that. So be sure to go look at capitalmindset.org and watch out for those articles, as well as other educational articles that are coming soon and other stock analysis articles.
Thank you, Fabio. This was the Capital Mindset Show. If you guys have liked what you've seen today, please be sure to leave a like, comment, and subscribe. And we're your hosts, Austin and Fabio, and we'll see you guys next time. Take care.